To keep yourself updated, subscribe to Indigo Learn and click the bell icon.
Hi friends, in these modules we'll understand about royalty accounting. But before we go on to understand the accounting aspects, we must first understand what is this royalty all about. Let us say there is one Mr. Ram who owns a plot of land, and one day he figured out that there is a reserve of coal underneath the land. Now he can extract the coal, he can sell it in the market and he can earn a lot of money, but he figured out that he does not have the business knowledge of coal, he doesn't have money to invest in the mining facilities. So instead what he did was he approached one Mr. Sham and he told Sham that, see, I have a land and there is a coal reserve underneath the land. You extract the coal and you sell it as a part of your business. Pay me some rent in return for that. Sham also said, okay, I'll pay you rent. So what did Sham agree to? Sham agreed to rupees 10,000 per month of rent that he will pay to Ram, and in return for that he will extract the coal and sell it in the market. Okay. Now Ram was initially very excited, but later on he figured out that what if Sham employs a lot of labor, a lot of capital investment is done, and he takes away all the coal in 2 months itself? Will I not be at loss? Yes, you will be at loss. Or what if the coal reserve is such huge that Sham will earn lakhs and lakhs of rupees and I will get only 10,000 rupees? Now this is not fair to me. Why will I lose such a huge amount of money? That asset belongs to me. I am just giving him to extract the asset and sell it in the market, and what I am getting is a very small sum of 10,000 rupees. So Ram gets an idea. What he says is, you pay me this 10,000 rupees of rent. Over and above the rent, whatever you are paying me, pay me 10% of the value of coal that you get from my coal mine. Now what is Ram doing here? Ram is asking 10% of the value of the coal that Sham is able to extract from the land. Now how will this benefit Ram? More and more Sham extracts the coal, Ram will get higher return, right? Let us say Sham extracts coal worth 1 lakh rupees. Ram will get 10,000. If the coal extracted is 2 lakh rupees, Ram will get 20,000. So the more the production, it is beneficial to Ram. Now this percentage payment that Sham is making to Ram is called as royalty. Now why is this royalty paid for? The royalty is paid because the owner of the asset is allowing the other party to take the benefit out of that asset. In general circumstances, the owner is called the lessor, the person who takes the land on rent is called the lessee. So what is a royalty payment? A royalty payment is a payment made by the lessee to the lessor for using the right which belong to the lessor. See, in this case, Ram had the right to extract the coal, correct or not? But did Ram extract? No. He gave the right of extraction to Sham. For getting this right of extraction, Sham is making a periodic payment which is computed as a percentage of the output. This value which is computed as a percentage of output is called as royalty. I am repeating it friends once again. The person who gives it on rent is called the lessor. The person who takes it on rent is called the lessee. Ram is the lessor, Sham is the lessee. Sham makes a periodic payment based on the output. That is called royalty. Now, from Sham's point of view, isn't this monthly payment an expenditure? Yes, definitely it is an expenditure. So he will book an expenditure as and when he pays royalty to Ram, or as and when the royalty becomes due. For the lessor or Mr. Ram, whatever he receives as royalty, that becomes his income. A simple accounting, but there is a small twist to it which we will understand in some time. So let us look at the definition of the terms that we just understood. A lease is an agreement whereby the lessor conveys to the lessee in return for a payment or a series of payment the right to use an asset for an agreed period of time. So what happens here? What is a lease? It is an agreement between the lessor and the lessee. In our case, it is an agreement between Ram and Sham, whereby the lessor conveys to the lessee. So in our case, Ram has given the right to extract to Sham. So the lessor conveys to the lessee in return for a payment or a series of payment the right to use an asset for an agreed period of time. So what was the asset here? The asset here was land. Who gave the right to use? Ram gave the right to use. Ram becomes the lessor, Sham becomes the lessee, and a periodic payment is done. Now this periodic payment can be fixed, in which case we call it a lease rental. If it is based on value of output or volume of output, we consider it as royalty. So what is royalty? Royalty may be defined as a periodic payment made by one person, that is the lessee, to another person, that is the lessor, for using the right by the lessee vested in the lessor. So whatever the right the lessor had, he gave the right to the lessee. Because he has given the right to the lessee is making a periodic payment. And friends, royalty is generally based on value of output or volume of output. It depends on the arrangement between the lessor and the lessee. Let us look at some other cases where royalty is involved. Say there is an author who has written a book. He has given that book to a publishing house for publication and sale, right? Now, the publisher will make a periodic payment to the author of the book based on the sales, maybe some percentage computed on the sales, or maybe some amount fixed per book. So that payment by the publisher to the author is also a royalty. Another case there could be a royalty is, let us say someone has invented something, let's say a machine, and he has the patent for that machine, but he doesn't have money to manufacture and sell that machine. He gives away that patent to somebody else, and based on the production and sales done by that other person, the person who owns the patent, he is charging certain amount as a percentage, or on per unit basis he is charging some amount. Even that will be considered as a royalty. Or sometimes you may take up some franchisee. Let's say you take up McDonald's franchisee. Now for using the name of McDonald in your outlet, McDonald may say that pay us 10% of whatever sales you make. Okay, even in that case there is royalty involved. So it is not just renting something. Maybe there is a copyrighted material again for which the publisher is paying royalty. There could be patents for which the person who is using the patent, he is making the payment of royalty, or there could be a usage of brand name against which royalty is charged. So there could be multiple cases where royalty is involved. But friends, please note that there is someone who owns an asset, either a physical asset or an asset which is intangible asset, or some licenses or some patents. Some person is owning them, the other person is using those assets. So the person who uses that asset will make a periodic payment. That periodic payment is called royalty, when that royalty is based on output or volume. So what are some of the examples for royalty payment? The one could be extraction of oil, coal, minerals. So we took an example of coal. There could be an extraction of oil also. So some companies who take these oil reserves on lease and they extract oil, they will make a periodic payment of royalty to the government, right? So there could be again minerals extraction like iron ore extraction or any other mineral extraction. Another example could be, as we discussed, to an author for sale of his books. Who will pay in this case? The publisher. Then to a patentee for the use of patent. So someone who has a patent, and if some other person wants to use that patent, maybe he will pay some royalty. Another one could be for use of technical know-how developed by another party. So one party has developed a technical know-how, a technology which the other party is using, and the person who has developed the technology is actually demanding royalty. Now friends, one thing that you need to keep in mind is, it is not always necessary that if a patent is being used, royalty will be paid. Maybe the patent has been given for a fixed sum, that is also possible, but whenever it is based on volume, output, we consider it as royalty. Now that we have understood what is royalty, what are the examples of royalty, who is a lessor, who is a lessee, we will take a small example to understand the concept of minimum rent. Okay, we will assume that there are no fixed rent payable. We will understand the concept of minimum rent. Say for example, there is a lessor, okay, he owns a land, and there is a lessee, Now let us say the land has coal mines, Now lessee can extract the coal and he can use the coal for his purpose, or he can sell the coal in the market. Now these two parties have agreed upon a royalty amount. And what is the royalty amount? The royalty amount says 15% of value of output. 15% of value of output. Who will pay this amount? The lessee will pay this amount to the lessor. So the lessor will receive this amount. Are we clear? Yes. Now let us say in the first year, year 1, the total value of the coal extracted is 30,000 rupees. Okay, the total value of the coal extracted is 30,000 rupees. So the value for the first year is 30,000 rupees. What is the royalty payable? The royalty payable is 15% of 30,000, which is, how much is 15% of 30,000? It is 4,000 4,500. So, rupees 4,500 will be paid by the lessee to the lessor. It's a straightforward computation. This is a straightforward computation, and every period based on the volume of output or value of output, the lessee will pay to the lessor the sum that has been computed. But imagine in one particular year, the output is not 30,000, let us say in year 2. In year 2, the output was only 1,000. Is it possible? Yes, it is possible. In fact, Reliance in the KG6 basin, they have not been able to extract the gas that they had expected, right? So, it is possible that the extraction is very less than expected, because what is there underground, nobody knows. You can just make an estimation, right? So, in the next year it is 1,000. So, how much is royalty? The royalty is only rupees 150. Now, the lessor thinks, what is the fun in giving a piece of land for extraction for only 150 rupees? So, what the lessor introduces is something called a minimum rent. Now, what is this minimum rent? The lessor tells the lessee, boss, extraction business is yours. I don't know how much is lying underneath the land. You pay me a minimum rent of 10,000 rupees. You pay me a minimum rent of 10,000 rupees. Now, what does this mean? This means that even in year 1, though the royalty was payable at 4,500, the lessee will have to pay 10,000 rupees. So, lessee will have to pay 10,000 rupees in year 1. Again in year 2, royalty is computed as 150, but the lessee will have to pay rupees 10,000. Lessee will have to pay rupees 10,000. Let us say in year 3, the extraction is 1 lakh. The value of extraction is 1 lakh. How much is the royalty payable? Royalty payable is 15,000 rupees. Royalty payable is 15,000 rupees. Now, is this 15,000 more than the minimum amount set by the lessor? Yes. Now, if the amount is more, the lessee will have to pay the higher amount. What did we understand here? If the royalty computed is less than the minimum amount, the lessee will pay the minimum amount to the lessor. So, in the first year and the second year, when the amount was less, when the amount of royalty was less, in the first year it was 4,500, in the second year it was 150 rupees. In that case, lessee will pay 10,000 rupees to the lessor, which is considered as minimum rent. But if the royalty is more than this minimum rent amount, so let's say in the third year the royalty worked out was 15,000, in that case the lessee will have to pay 15,000 to the lessor. Now, this amount of 10,000 which the lessee must compulsorily pay irrespective of the output is called as minimum rent. Sometimes it is also referred to as dead rent or rock rent or fixed rent. Amount which is payable irrespective of the output is called minimum rent. Now, what is the advantage? The lessor gets a protection that even if the output is less, I will get at least 10,000, and if the output is higher, I will get the higher amount. So, always remember friends, the royalty payment will be higher of the royalty computed or minimum rent. If royalty computed is higher, the lessee will pay the royalty computed. If the minimum rent is higher, means if the royalty computed is lower, the lessee will have to pay the minimum rent. Now, look at this friend from the lessee's point of view. Though the lessor is very happy, the lessee has paid 10,000, whereas the actual royalty worked out to only 4,500. So, how much is the loss to the lessee in this case? If we have to compute 10,000 minus 4,500, the lessee has lost 5,500 in the first year. This loss of 5,500, which is nothing but the difference between minimum rent and royalty computed, is called short workings. What is this called? This is called short workings. This is called short workings. What is the short working in the first year? 10,000 minus 4,500, 5,500 is the short working. What is the short working in the second year? 10,000 minus 150. How much is that? 10,000 minus 150 is 9850. So, the short working here is 9850. So, these two numbers are the short working numbers. Is there any short working in year 3? In year 3, the royalty is higher than the minimum rent. So, there will be no short workings. Are we clear with this? There will be no short workings. Now you may think, for the lessee, isn't it a loss? He is unnecessarily paying the minimum rent and without getting any benefit. Yes, there is a loss, but that is how the agreement has been entered into. Now, there could be a small twist in the agreement or an additional condition in the agreement, that whatever are these short workings, can be recovered in the future year, which we understand as recoupment, Now, what does this recoupment mean? Let us understand. In the first year, the short working was 5,500. In the second year, the short working was 9,850. How much is the total? It is 5,500 plus 9,850. The total is 15,350. What is the total of these two? Short workings here is 15,350. This is the total short working. Now in the year 3, if you see, isn't there a surplus? 10,000 was the minimum rent and 15,000 was the actual royalty payable. Yes. What is the extra amount that is paid by the lessee in this case? 5,000 rupees. What recoupment means is, I have paid excess royalty of 15,350 in year 1 and year 2. If there is a recoupment provision, this 15,350 can be adjusted against this surplus, which means instead of paying 15,000, what I can do is I can still pay 10,000. And this 5,000 extra will be adjusted against the excess amount which I had paid earlier. This is called recoupment. So in year 3, if there is a recoupment provision, how much amount will the lessee pay to the lessor? The lessee will pay 10,000 to the lessor, which is the minimum rent, But you may say, sir, actual royalty is 15,000. Yes, now the 5,000 of extra royalty which is payable will be adjusted against this 15,350 which was paid in the earlier years. Now, after that has been adjusted, after 5,000 has been adjusted or recouped, we call it recouped. After 5,000 has been recouped, the short working balance is 10,350. Short workings balance is 10,350. The lessor and the lessee may have these kind of conditions also in the lease agreement. So what did we understand so far? There is a concept of minimum rent, and if the royalty computed is less than the minimum rent, the lessee will have to pay the minimum rent. And the difference between the minimum rent and the royalty computed is called as short workings. And if there is a provision in the agreement, the short workings can be recouped in the future, or the short workings can be set off in the future. Now what we will do is, we will take one more example to understand how this recoupment happens, what happens to the recouped amount, and is it that we can recoup the amounts for an indefinite period. All these things we'll understand using an example. Let us take an example. Let us say there is one Mr. X who is the lessor, and there is one Mr. Y who is the lessee, okay, and there is a coal mine, and what they have agreed is rupees 10 per ton. Rupees 10 per ton is the royalty. What is the royalty? Rupees 10 per ton. Now it can be on percentages basis, it can be on output basis, either ways it is possible. And the minimum rent is 10,000. Minimum rent is 10,000. Let us say in this year 1, year 2, year 3, year 4 and year 5. There are 5 years we are considering. In the first year, the output was 4,000 tons. How much was the output? 4,000 tons. Now, what is the royalty? The royalty that we will compute is 4,000 into 10, which is 40,000. Now, what is the minimum rent? Minimum rent is 10,000. What will the lessee pay to the lessor in the first year? The lessee will pay 40,000 in the first year, because the royalty computed is more than the minimum rent and there will be no short workings. Are we clear? Okay, let's go to year 2. In year 2, the output was 1,000 tons. Okay. Now, for this 1,000 tons, how much is the royalty? 10,000 is the royalty. Correct? How much is the minimum rent? 10,000 is the minimum rent. How much will be paid? Because both are equal, it doesn't make a difference, but still the royalty computed will be paid by the lessee to the lessor. Then in the third year, the output actually fell down to 750 tons. Output actually fell down to 750 tons. How much is the royalty computation? 7,500. How much is the minimum rent? 10,000. Now, what is the amount the lessee will have to pay? Because the actual royalty computed is less than the minimum rent, the lessee will have to pay 10,000, which is the minimum rent. Now friends, with this discussion, can we conclude that the lessor will get minimum rent, at least minimum rent will be received. If the actual royalty is higher, he will receive the higher amount. So in year 3, the lessee will actually pay this 10,000 rupees. Is there a short working? Yes. Whenever the minimum rent is more than the royalty computed, there is a short working. How much is the short working? 10,000 minus 7,500, 2,500. This is the short working. Now, multiple scenarios are possible. The first scenario could be this short workings is lost in the current year. There is no provision for set off in the future. Means if the agreement says that there is no provision for set off in the future, this 2,500 is a gone case. The lessee pays 10,000, that becomes the expenditure and it is done. Okay. But if there is a provision for recoupment, let us say the lease agreement has a provision that short workings arising in any year can be set off in the next 2 years. What does it say? Arising in any year can be set off in the next 2 years. So what happens? In year 4, the actual output becomes 1200 tons. What is the royalty? Royalty is 12,000. And how much is the minimum rent? 10,000. Is there any short working? There is no short working in this case. But if there was a provision to set off the earlier short workings, which is 2,500, how much will be set off here? What you will do is this 12,000 minus 10,000, because 10,000 anyways you have to pay to the lessor. Anything above 10,000, out of that you can adjust something. So what is the surplus? This 2,000 of surplus, this will be used to adjust this short working. This will be used to adjust this short working, which means short workings now 2,500 was short. Now 2,000 you have adjusted, you are left out with balance of 500. Are we clear with this? Okay. Now come to year 5. Let us say in year 5 the output is 1100 tons. Output is 1100 tons. What is the royalty payable? 11,000. What is the minimum rent? 10,000. How much will be paid? Will we pay 10,000 or 11,000? First check whether there are any short workings and read the lease provision. Short workings arising in any year can be set off in the next 2 years. So when did it arise? It arose in year 3. So you can set off here and you can set off here. Now come to year 5. 10,000 is the minimum rent, 11,000 is the royalty computation, 1,000 is the surplus. And how much of short working balance we have? We have 500 of short working balance. This 500 of short working balance will be adjusted and now the rent paid will be 10,500 or the royalty paid will be 10,500 and the short workings balance is over. There is no balance in the short workings account. Now let us assume that this short workings instead of being 2,500 was 5,000. So let us change our example. So the output in year 3, let us assume it was 500 tons and the royalty becomes 5,000 and the short workings become 5,000, right? Now this short working 5,000 can be adjusted in year 4 and year 5. So in year 4 what will happen? You will adjust 2,000 and you will be left with 3,000 of short working. So the balance here will be 3,000. Then come to year 5. What is the surplus available? Actual royalty is 11,000. Minimum rent is 10,000. So up to 1,000 you can adjust. So in year 5 you will adjust at 1,000 and actually pay 10,000. What is the balance in short workings account? The balance in short workings account now is 2,000 because 3,000 was the balance, 1,000 we adjusted, it became 2,000. Now if the lease agreement had a term saying that or had a condition saying that recoupment can happen only in the first 2 years, recoupment can happen only in the first 2 years or only in the first 3 years, which means if you have any short workings in the first 3 years, assuming it is 3 years, in the first 3 years you can recoup the short workings, after that you cannot recoup the short workings. In that case what would have happened is this short workings of 5,000 in year 3, because the agreement says you have to recoup it within the first 3 years, this cannot be carried forward and adjusted in year 4 and year 5. So in year 4 and year 5 the lessor will receive the actual royalty. So in that case the lessor will receive 12,000 here and 11,000 here. All this would be irrelevant because you cannot carry it forward beyond 3 years. Let us just twist the example and say the short workings can be recouped in the first 4 years. So, just remove this. If it says in the first 4 years, which means you can have the recoupment till here. So, this 5,000 you can adjust by 2,000 rupees in year 4. Beyond that you cannot adjust. What would have happened in year 4? Instead of paying 12,000, you would have paid still 10,000, and this balance of 3,000, this would have been lost. This would have been lost. Now, this is called fixed recoupment. So, what is a recoupment? If there is any short workings, if you can set it off in the future period, that is called recoupment. And if it is a floating recoupment, it can arise in any year and for a period of time you can recoup that. If it is a fixed recoupment, it can be set off only in the year which has been fixed. So, that is how the name comes, fixed and floating. Now that we have understood what is the meaning of short workings and how they can be recouped, let us take the illustration itself and understand how do we pass the accounting entries. Okay. Now, with the same illustration we will be passing the accounting entries, and our assumption is that this short working can be recouped within the first 4 years. What is our understanding? Within this first 4 years you can recoup your short workings. Okay. Now, we will understand what would be the entries in the lessee's book and what would be the entries in the lessor's book. Okay. Now, who is making the payment? The lessee is making the payment to the lessor. In the books of lessee, it is an expenditure. Correct or not? In the books of lessee, it becomes an expenditure, and in the books of lessor, it becomes an income. Now, when royalty is due in normal cases, the lessee will treat it as an expenditure, and hence it will debit the royalty account, which is a nominal account. So, what will happen? Let's say in year 1, how much is royalty that is payable? For 4,000 tons at 10 rupees, the royalty computed is 40,000, minimum rent is 10,000, but because the actual royalty is higher, the lessee will pay the higher amount. So, the first entry will be to recognize this royalty as an expenditure. So, what will be the entry for that? You will have, let's say this is the lessee's book. Royalty account, how much? 40,000, royalty account debit 40,000 to the landlord account 40,000. Now, I am using the word landlord. In our case, X is the landlord and we are preparing it in the books of Y. We can use the actual names also. So, what is the first entry? Royalty account debit to landlord account 40,000. This is in the books of lessee. What will the lessor pass? Let us say in the books of lessor, I am talking about books of lessor. Now, the expenditure for the lessee, 40,000 of royalty, is an income for the lessor, and we know we will credit the income account. The lessor will have to credit the income account, and from whom is it receivable? It is receivable from the lessee. So, the lessor will pass an entry saying lessee's account debit 40,000 to royalty account 40,000. Are we clear with this entry? I am repeating it once again. For the lessee, royalty is an expenditure. It is payable to the landlord. It is payable to the landlord. That is why we are creating a liability in landlord's account. We are crediting the landlord account. We are increasing the liability. So, the lessee will pass an entry, royalty account debit to landlord account 40,000. Correspondingly, in the books of lessor, lessor will consider this as an income. Lessor will consider this as an income, and because it is an income, an increase in income, you will credit the income account and you will debit the person who has to pay the income, and in this case it is the lessee. I hope the first entry is clear to you. Okay, this is the entry for recognizing the expenditure. Now, come to the second entry. Now, this expenditure which lessee has recognized, he will pay it to the landlord one fine day. On the date of payment, you will pass an entry saying landlord account debit to bank account. Why are you debiting the landlord account? Because the landlord is the receiver here. You are paying something to the landlord. The liability is coming down. So, you will debit the landlord account by 40,000. And you will credit which account? You are paying it through maybe bank or cash. Depending on that, you will credit either bank account or to the cash account. So, the entry will be landlord account debit 40,000. This is debit to bank account 40,000. Now, this is for payment of the royalty. Come to the lessor's account or come to the landlord's account. In the lessor's account, lessor will receive the money. So, he will debit bank account, and who is paying the money? The lessee is paying the money, so he will credit lessee's account. So the entry will be bank account debit 40,000 to lessee's account 40,000. I hope this entry is also clear. Then at the year end, the royalty account, which is a nominal account where the lessee is recording the expenses, will be transferred to the trading account or to the profit and loss account or to the manufacturing account, depending on the nature of the expenditure. If it is something to do with the manufacturing, maybe you will transfer to the manufacturing account. If it is considered as a direct expenditure, you will transfer that to the trading account, or if it is considered as an indirect expenditure, you will transfer that to the profit and loss account. So, to transfer the expenses to profit and loss account, what will be the entry? You will transfer this royalty account 40,000 rupees to P&L account or to trading account. So the entry for that will be trading account debit, or it could be P&L or it could be manufacturing account 40,000 to which account? To royalty account 40,000. Similarly, in the lessor's book at the year end, the royalty being an income, it will be transferred to trading account, profit and loss account or manufacturing account as the case may be. So what will be the entry for that? To transfer this royalty, you will debit royalty account 40,000 to either your trading account or to your P&L account or to your manufacturing account as the case may be 40,000. So these are the three entries that you would pass in a normal circumstance, or in the normal scenarios you will pass these three entries. Now sometimes you can designate this account as royalty paid account, and for the lessor you can say royalty received account. Both are same, because sometimes it may so happen that the same party is also paying royalty, he is also receiving royalty. So that to make a distinction you can say royalty paid account and royalty received account. I hope you are clear with these entries. Now the entry for year 2, coming to the year 2, will the entry change? The entry will not change. Again here 10,000 is the royalty, you will book an expense in the lessee's book, you will book it as an income in the lessor's book, and you will make the payment and then transfer to profit and loss account.